Welcome to the CFA Society India podcast, where society members engage in conversations with industry experts to bring you unique insights. This podcast represents the views and opinions of the originally featured speaker and is posted with their express consent. The podcast is meant for educational purposes only. It should not be construed as research, recommendation, solicitation, or investment advice by CFA Society India. Now, let's dive into today's episode.
Hello, everyone. Welcome to the CFA Society India podcast. My name is Jolly Balva, and I'm the host for today's episode. I also host my podcast called Investing and Purpose. In today's episode, we are going to look at gold. And gold as an asset class has a history of more than 2,000 years. It has stood the test of time across wars, calamities, economic crises, and expansions as well. Of course, the fundamental drivers for its price have varied across time periods. It is quite a unique asset in itself, and it contributes to a long-term portfolio in more ways than one. To discuss these aspects, I am joined by World Gold Council's Sheela Kulkarni and John Reade. John is a market strategist for Europe and Asia. Sheela is the head of market development and institutional investor relationships in India. Welcome, Sheela and John.
Hi, thank you.
It is quite an interesting time to be discussing gold. And so to start with, John, if you could explain about how an allocation to gold can, how does it affect the portfolio performance?
Yeah, well, thank you. I'd love to do so. We've looked at portfolios across the world. We've looked at portfolios denominated in different currencies, portfolios that hold various assets, whether they're fixed income heavy or equity heavy or with lots of alternatives in them. And over the last 5, 10, 20 years, or all the way back to 1971, having gold in your portfolio in an appropriate amount has increased the risk-adjusted return of that portfolio. And it's reduced the drawdowns that portfolio has seen during the worst events that have taken place for financial markets over that period. Now, it does this in 3 principal ways. The first of all is with returns. Now, people think returns from gold occur during crises, during periods of high inflation, maybe during wars. And although that's true, it's not the full story. So gold's performance over the last 5, 10, 20 years since 1971 has been in line with or better than most other major asset classes, delivering compound US dollar returns of between 8 and 9%. So, you know, it's not just for the bad times. Gold's been for all the times, particularly when you hold it over a longer period. The second part, though, is the diversification benefits that gold brings to a portfolio. So gold's generally uncorrelated to equities. And I say generally. So if you look over the long run, returns in gold uncorrelated to returns in equities. But during certain circumstances, that correlation shifts. And that's really quite useful because when equity markets are rising really quickly, so up by more than 2 standard deviations in a week, gold has and it depends on the market, but it has a small, maybe a medium-sized positive correlation. But when equity markets are falling fast, so down, say, 2 or 3 standard deviations in a week, gold's correlation flips over and it becomes negatively correlated to equity returns. That flip over in correlation is almost unique. We've looked at all other asset classes and loads of different assets to see whether anything else does it. And really only silver exhibits the same sort of characteristic, which makes sense because silver is very correlated to gold. So that combination of returns plus diversification, and diversification that works when you really need it the most, means that the portfolio impact of having an appropriate amount of gold in a portfolio is really quite good. Now, I often get a question, how much gold should I have in my portfolio? And the answer is, it depends. And it depends really what's in the rest of your portfolio. If you've got a very fixed income heavy portfolio, then you're ideal asset allocation or target asset allocation to gold should be quite small, maybe 3, 4, 5%. If you've got a very heavy equity portfolio, particularly risky high beta stocks, maybe some cryptocurrencies in there as well, which, also exhibit equity-like correlations, then you probably end up with a higher allocation, 8, 10%, potentially even higher. But generally speaking, we say to people 5 to 10% is about the right amount. And depending how much risk you've got in a portfolio, you should have more rather than less.
Interesting. If we could slightly zoom in and see the roles that it plays, and especially like with different economic cycles, for instance, or rather it enjoys the moniker that it is an inflation hedge. But if we look at specific time periods, it has kind of been a mixed bag. So if you could elaborate a bit on that. And also, of course, I mean, there's something which is indisputable, which is that its role is of a store of value. Now, again, like the expansion of, money supply, it spurs inflation, and then gold ends up benefiting in the long run as well.
I guess the first thing to say is gold has a very long history, but its relationship with money changed in 1971. Up until 1971, there was a direct or indirect link between gold and the US dollar, and therefore other currencies as well, which were tied to it. So prior to 1971, with the gold price fixed, then gold held its value in the long term. Since 1971, we've seen gold act as a hedge, or it's held its value in real terms and more. So I think that's the first point. It's not just a zero real returning asset. Work we've done suggests that over the long term, it should deliver somewhere between 2 and 3% in excess of inflation. So it's a long-term store of value. It's a long-term protector of value. In terms of inflation and specific inflation protection, it works, but perhaps not in the way that people expect it to work. We found the best correlation between gold returns and a measure of inflation comes from money supply. And there's a good example of this in the last few years with the COVID pandemic and the economic recovery from it. So we went into the pandemic, economic activity falling around the world, lockdowns, unemployment, big stimulus checks from government, and lots of central bank direct action, cutting interest rates to virtually zero in most cases, and expanding balance sheets, so-called printing money. Money supply was growing really fast in 2020, and gold was one of the best performing assets, up about 25% in US dollars over the year. But that was in an environment when we didn't have any inflation. The inflation came in 2021 and especially 2022 and into this year as well, although declining in most of the world. So gold's performance in 2021, 22, and 23 has been much more pedestrian. And that has led to a lot of questions, is like, why isn't gold performing when inflation's high? And I think the answer to that is, well, you got your inflation protection performance before inflation came along, because gold reacts to monetary debasement or fears of monetary debasement. So when money supply expands really rapidly. And since 2020, money supply growth has slowed dramatically, even turned negative from time to time. And that's probably one of the reasons why gold has performed less well since 2020. I think the other thing I'd say as well, when thinking about gold's returns, if you assume, and this is a big assumption at the moment because it certainly isn't the case, but if you assume long-term inflation is 2%, and you assume that our valuation methodology, which suggests that gold can deliver 2 to 3% real, then you should be expecting about, in US dollar terms, 4 to 5% increase per annum on average over the very long time. Fine. So what happens after gold's delivered 25%? Well, I think the chances of another 25% in the following year is extremely slim. So there is some expectation, I think, of a bit of mean reversion. If gold's performed really strongly one year, perhaps due to massive intervention by central banks or governments, then the chances are it doesn't do the same again the following year. And that's very much what's happened.
There are also some short-run factors, and as you mentioned, demand being one of them, like what central banks do. So this brings to my next question now, because lately a lot of things have been happening, and if we could talk about the demand trends a bit and starting with the central banks and their investment demand, because
Sure.
What I have seen is like the emerging market central banks, they have doubled their holdings on gold as a reserve asset, and they have replaced treasury securities, especially as compared to the post GFC times, the buying rates in those times. So on one hand, there are these talks about a change in the world order, deglobalization and de-dollarization and things like that. And but apart from that, the U.S. Treasuries also, of course, have had their own situations. I mean, the market participants have had a good taste of interest rate risk, and lately also the rating downgrade as well. So
Sure.
A lot is happening together. And if you could elaborate on what really is happening with the central banks, like why is there a change, long-term change in stance that they are having here?
I think it's very possible that there has been a long-term change in behavior from central banks over the last 12 months or so. I mean, it's not the first time. We saw a big change in the stance of central banks around the time of the global financial crisis.
Yes.
Developed market central banks, which held the majority of the gold in central bank reserves, and still do. But developed market central banks have been selling gold for about 21 years consecutively up until the GFC, and then stopped because the gold price went up a lot, stopped because they recognized the benefits of having gold in a portfolio, and also the alternatives, government bonds, suddenly weren't yielding anywhere near as much as they were. So there were good reasons why the developed market central banks stopped selling gold, something that's likely to persist in our opinion. What we saw, though, is we saw emerging market central banks who had amassed trillions of dollars of foreign exchange reserves since the Asian financial crisis in 97, but they hadn't been adding gold over that period. So that left them very underweight gold. And I think that a recognition, again, of how gold had performed during the GFC, the fact that the price was able to increase when pretty much all other assets were under pressure, persuaded emerging market central banks to increase their weightings in gold. So since 2010 up until 2021, central banks bought about 470 tons of gold a year on average collectively. Out of a gold market size, new production is about 3,600 tons, to put it in perspective. So they've been buying a substantial amount of the world's gold production. What's happened over the last 12 months, though, is that the rate of purchases by central banks has increased quite dramatically. We saw 1,100 tons of gold bought by central banks in 2022. 800 tons of that was bought in the second half of last year. Now, purchases have slowed down a bit in 2023 for a number of reasons, perhaps an underlying decline in the rate of buying, plus also some sales coming through from specific countries, mainly Turkey, for reasons connected with their own economy and the elections there. But broadly speaking, we're still seeing strong central bank purchases. First half purchases by central bank, which we just reported in our gold demand trends, was a record. And we're expecting to see ongoing strong central bank demand in the second half of the year. Probably doesn't match what we saw in the second half of last year, but we do think there's a decent chance that the accelerated or increased purchases that we're seeing from central banks will continue. So why are they doing this? Well, I think you mentioned, Jolly, a couple of things in the question that may be playing a role. There is, I think, a clear desire from many countries to make less use of the US dollar. We've heard statements from many of the leading emerging markets that they're frustrated with the US dollar dominance and that they would like to use it less. I think the second point, though, is more a pro-gold argument rather than anti-US dollar. I think the pro-gold argument comes from a recognition by central banks that we've probably seen a change in the inflation regime. If you think about the last 10 years, globally, central banks have struggled to get inflation up to and to stay at their target range. The expectation may be going forward that the inflation problems that the central banks will have with their targets is getting inflation down to and remain at or nearby their targets. So in other words, inflation being too high rather than too low. Linked to that, of course, I think we are in a situation where geopolitical stresses are probably going to be higher in the next 10 years than they have been in the last 10 or 20. I mean, that's not to say we didn't have conflict and wars. Of course we did. But I think the magnitude of the wars and the potential wars that could take place is worrying people somewhat. Not just the between Russia and the Ukraine, but the trade tensions between the United States and China, and to a lesser extent, the European Union and China, together with concerns about quite what's going to happen with Taiwan as well. So if we're in a higher geopolitical risk environment, again, holding gold or holding more gold in your reserves does make sense. And then the final thing, I think, is related to the actions that were taken against Russia following its illegal invasion of Ukraine, the sanctioning of the Central Bank of Russia and the freezing of a large proportion of its international reserves may be making some countries and some central banks want to own assets that don't carry that risk. By owning more than 20% of its reserves in gold held in Russia, Russia has access to a greater proportion of its foreign exchange reserves than it would have been the case if it was invested in the treasury market or European bonds or etc. So I think that action has been noted by other central banks, many of them are realizing that Western nations will, under certain circumstances, use pretty drastic financial sanctions against other countries. So those things in combination, I think, are helping drive an increased pace of purchases by central banks. But this could continue for a long time. If we look at the reported additions to China's central bank gold holdings, they've been one of the most active buyers in the last 12 months or so, and yet they still have less than 4% of their reserves in gold, based on numbers we have as at the end of June. Similarly, Singapore has been a rare developed market buyer of gold over the last year or two, and its holdings have increased only to just over 4%. Now, typically, developed market central banks have probably closer to 20% on average of their reserves in gold. So we could see this sort of buying take place for a very long time to come.
Very interesting, John. And, this reminds me of a report which I had come across. This report was again by World Gold Council, but slightly older one, and which had done a survey of central banks and asking them the reasons of why they're increasing the holdings. And I mean, apart from the usual reasons which got the heaviest weightage, the usual reasons being, hedge against the devaluation of other currencies and, wanting to balance their foreign exchange reserves and things like that. But apart from that, one of the things which was asked in the survey was, if de-dollarization policy was a relevant reason for them. And interestingly, I think around 10 to 11% of them said yes. And majority of those central banks were emerging market central banks.
Sure.
So it's interesting to see that this was happening like even a few years back as well. So
I think that's right. And don't forget, one man's de-dollarization is another man's diversification away from the US dollar. You don't have to hate the US dollar or perhaps the country that's behind it to want to reduce your proportion of holdings in it. I mean, the world recognizes particularly the growth in emerging markets and their increasing share of global economic activity. And that will ultimately be reflected in currency holdings of central banks.
True. So, in that case, John, like, would you think that institutional investors are also kind of likely to follow suit? Because central banks, if they are like thinking to hold gold like in larger quantities, would that also affect the behavior of institutional investors?
That's a really good question, and it's not one that I've thought of before this conversation. I think that in general, across broad-based institutional investors, I think the activities of central banks regarding what they hold is of limited impact. And the reason I say that, central banks historically and typically own bonds, government bonds, or quasi-government bonds like agencies, and they own gold. They don't normally hold equities, although with the balance sheet expansion that we've seen from Japan and the currency intervention from the Swiss National Bank, that's not always the case. But in general, what central banks are doing is very much related to a few assets. Institutional investors obviously can invest in a lot more. So the fact that central banks are buying gold, I don't think triggers institutional investors to automatically follow suit. I think it probably will have some impact upon the activities of sovereign wealth funds because they behave, well, there's not one typical sovereign wealth fund. They're all very different. But it's possible, I think, to generalize and consider them to be somewhere halfway between an institutional investor on the one hand and a central bank on the other. So I do think it might be influencing their thinking slightly, and we do believe there has been a fair amount of purchases from sovereign wealth funds. But in terms of moving the dial for institutional investors, no. I don't think it's going to be a major factor. Institutional investors are much more interested in returns than they are about safety and security. They are risk-taking organizations who are trying to generate returns for their clients. Now, I still think there's an extremely good case for them to be holding gold as part of their portfolios of assets, but it's not necessarily the same reasons why central banks would need to do so.
Absolutely. So now if we could discuss about the demand trends from other sources like jewelry or electronics.
Sure. And touching on jewelry first, I mean, it is a measure of how the world has changed in the sort of 33, no more than that, 36 years since the World Gold Council was formed in 1987. When we were formed, virtually all demand for gold fitted into the jewelry and technology sector. Investors were a much smaller component of the market, and central banks were selling. That was back in the day when the central banks were selling gold. Now we're at a situation where over the last decade, jewelry demand represents about 38% of aggregate gold demand, and technology about 7%. So both of these factors are driven by wealth, prosperity, economic growth, income, all of those positive factors. And they've done well. They've also become a very much more emerging market story. When we started, about 2/3 of gold demand was into developed markets, so Europe, North America, Japan, a few others, and only about a third of the gold demand was going into emerging markets. Now the situation is completely reversed, and over the last 10 years, something like 73% of consumer demand for gold has gone into emerging markets, principally driven by China and India, which together make up just more than about 50% of consumer demand for gold. So that story has been one of emerging market growth and prosperity, and I think greater cultural affinity to own gold, both in jewelry form, but also investment form as well. So jewelry, it's not the biggest component that it used to be. That's now the investment category, which we differentiate from central banks. We segregate that away. But investment's about 43%, I think, from memory. Jewelry about 38%.
Yes.
But it is a very important category. And perhaps We were talking in the research team of the World Gold Council when we were writing up gold demand trends a few weeks ago. And one of the big standout factors that we took away from the data for gold demand trends is just how strong the jewelry market is, considering gold is at all-time highs in basically every currency. So a keen demonstration that people have got used to higher prices and that they still want to buy decent amounts of jewelry. So if you've got jewelry demand driven by wealth, prosperity, and emerging markets, technology demand is slightly different. Technology demand is driven by gold's unique physical, chemical properties, particularly regarding conductivity and durability and malleability. You can craft gold into tiny wires that are at the heart of every chip, integrated circuit, that's in every electronic device around the world. And although you could use substitutes, perhaps silver or copper, you don't for good reason. If we were to stop using gold in technology, everything would be bigger, heavier, and would break more frequently, and you'd be replacing it much more quickly. So gold is at the heart of the 21st century, even though the component of technology demand is small compared to the to total gold demand. And then, as I say, investment demand driven by a number of factors which are different really from the consumer side of jewelry and electronics. Part of it is risk and uncertainty and fear, a desire to diversify a portfolio, to put an asset in there which will help you if bad things happen to the world, either politically or financially. Of that investment demand, and this comes often as a surprise when I tell people, it's not the financialized products, the exchange traded funds, the futures accounts, the allocated or unallocated gold accounts that are the biggest component. The biggest component of investment demand remains retail coin and small bar buying around the world. Tremendously large and important market. And it's, again, a mixture of emerging market and developed market people buying gold in physical form because of its characteristics. We've mentioned central banks as well. Central banks, as I say, have constituted about 18% of net demand over the last 10 years. But obviously, as I've discussed, over the last 12 months, it's been a larger component than that. So really, those are the four categories of demand for gold. They're very different. And that's one of the things that leads to gold market strength and resilience. And what I mean by that, when jewelry demand is strong, typically prices tend to be a bit weaker, investors not buying. That balances the market nicely. When the price goes up, typically jewelry buyers step back from the market, but investors are buying it. So there's a balance between economic strength and risk and uncertainty that means that gold isn't as volatile as other commodities. If you take commodities like oil or copper, basically they do well when the economies are strong. And when the economies are weak, there's nobody really to step in and buy it. So you see big peaks and big troughs. Whereas with gold, there's always a buyer, and there's a diverse range of buyers that buy under different circumstances and with different price expectations and motivations.
Interesting. John, so then that gives me a feeling that be it central banks or be it consumers wanting it for jewelry, but essentially a large chunk of it is coming from Asia. And
indeed.
And if you look at India also, like the attitude is that people buy it for the resale value of it. So, yes, jewelry is there, but because also it is easy to sell it as compared to other stuff. So
sell it, but also, crucially, borrow against it. For many Indian households, the only asset that they've got that they can raise borrowings against is their gold jewelry.
Yes.
And in a country where a large proportion of the population is asset poor, having something you can borrow against can be really, really important.
Yes, that has been a trend lately as well. If we could turn our attention to gold's ESG credentials, and because this is like mining heavy and the processing at all may be heavily sourced from the grid, like for the electricity. And so I'm just trying to understand how are producers working towards decarbonization, and what about the social aspects of the communities which are working in the mines?
Yeah, and I'll take those one at a time, although there is a linkage which I'll also introduce. Extractive industries have a bad reputation at the moment. I think that's very fair to say. We've seen difficulty for coal mines or oil companies to get finance to increase production or bring on new mines, etc. And there is a danger, I think, that all mining gets tarred with that same brush unnecessarily. So in many cases, I mean, ultimately, the transition to the world to net zero is going to need a lot of commodities, particularly things like lithium and copper, but also iron and steel and aluminium and all of the things that need to be dug out of the ground. And as I've mentioned, gold has technology uses as well, which are essential as well. But the mining industry recognizes, I think, that it needs to demonstrate its ESG credentials very clearly. Now, I'm a mining engineer by training, and I worked in the industry 30 years ago. We cared about the environment back then as well. It's just that it's become so much more of a focus for the world over the last 30 years, and increasing year by year, that the industry needs to both improve its performance all the time, but also communicate it a lot better as well. So specifically regarding decarbonization, it is, I think, the challenge that we face globally now and over the next 30 years, this move towards net zero, which is, I think, is going to be essential to reduce as much as possible the impact of climate change upon populations, the economy, and everything else that goes around it. So the gold industry recognizes that it needs to do its part. The World Gold Council, on behalf of its members, has spent quite a lot of time looking into ESG factors in the last few years. And the decarbonization story, I think, is particularly important. So the first thing we've done is to collect the data and make the estimates to see just how big a carbon emitter the gold mining industry is. And we've also laid out a pathway that the industry can become carbon neutral by 2050. Now, in some respects, it's actually quite an easy challenge. And you hinted at it in the question by talking about power. About 80% of gold mining's climate change emissions come as a consequence of energy, whether it's electricity, which they're using to work the mines underground and to process the material, or diesel, which the big yellow trucks that you will have seen photographs of moving hundreds of tons of earth or rock in one bucket, they're diesel powered typically. So if you can do something about the grid, in other words, where you're sourcing your electricity from, and if you can do something about the diesel powered vehicles, then you can tackle 80% of the climate change emissions in 2 steps. Now, in the case of grid power, what we're seeing increasingly is gold mining companies putting on their own sustainable power sources, so building solar arrays, in some cases wind farms, etc., tapping into hydroelectric power where it's available, so reducing their carbon-heavy electricity sourcing. In the case of diesel-powered vehicles, it's easier to tackle the smaller vehicles that are used in underground mines and to replace those with electric-powered vehicles. And some mines are now being commissioned with only electric vehicles underground, so that's great. The big yellow trucks that drive around the mine sites, I mean, some of these things with a load may weigh up to perhaps 500 tons. Batteries are never going to work for that. There is experimentation with hydrogen-powered huge trucks, something that Anglo-American, the diversified mining company, is experimenting with. And similarly, there's efforts to use electrical assistance on these trucks. So in other words, when they're hauling the ore the broken rock up from the bottom of the pit up to the surface, you hook onto an electric trolley assist, which allows electricity rather than diesel to provide most of the driving power. But it is an area that requires a lot more work and is attracting a lot of work at the moment. But through these two areas of replacing diesel where you can with electricity and cleaning up the sources of that electricity, it'll be possible to make quite rapid progress in decarbonisation. The other 20% of climate change emissions are going to be smaller individually and probably take longer to tackle. But with the whole global supply chain of everything trying to become less carbon intensive, there'll be some boosts that come along there naturally. Now, in terms of dealing with communities, that's always been an important part of mining. You're usually operating in either poor countries or poorer parts of richer countries when you're mining. The mines are up in the mountains or in the desert. They're generally where not a lot of people live. And the people that live there typically are resource constrained, whether that's water, whether that's arable land. And the last thing that they want is to see their livelihoods destroyed by mining. So partnering with communities is really important. Hiring locally, in other words, from the communities in which you work in, providing highly paid, skilled, semi-skilled jobs in environments where there's typically not been much formal employment, that's one way to help. Being very careful about the water that you're abstracting from the mine and making sure that it's clean when you put it back into the water supply afterwards. So to that extent, there's lots of things that gold mines do. Very conscious of the potential bad and potential good impact from gold mining. We spend a lot of time looking at how, when gold mining is done properly, how it is consistent with the OECD's Sustainable Development Goals. And we've published quite a lot of research on that as well, demonstrating the good that can be done by mining for gold, particularly in underdeveloped countries or underdeveloped regions of big countries. And one of the areas, I think, where there's a nice overlap with the decarbonisation is a lot of the countries that gold mines operate in don't have very big electricity grids. So when you build a mine, you've got to put one in. And if you're doing that increasingly with lower carbon intensity electricity production, what you're doing is you're actually helping the country or the region to be supplied with electricity, which obviously is good, but low carbon electricity, which is better, because mines don't last forever. And when they close, you will leave this legacy asset of electricity provision and cleaner electricity generation. So that's certainly one example of how gold mining can both move towards net zero, but also help the countries and the regions that it's operating in move towards net zero as well.
It's interesting to discover that there's a lot of work in progress here, and a lot of developments are happening on this direction. Now, if you could look at it from the investor's perspective, ESG investors and their attitude towards this asset, like across the light green to dark green spectrum of strategies. Yeah.
It's interesting. In general, my experience so far is that investors have focused their attention on ESG around what companies are doing. So in other words, looking at equities, looking at maybe corporate bonds. They're not actually looking too much at commodities. So we haven't had that many questions about gold's ESG credentials compared to, if we were representing a company and its share price. I think it's coming. I think we're getting to the stage where investors will be looking at the entirety of their portfolio to see the ESG impact of it. And from that perspective, gold has some positive stories to tell. In quantifying the carbon footprint of gold, we both quantified the total footprint, but also broke it down into scope 1 emissions, scope 2 emissions, scope 3 emissions. Almost uniquely, once gold has been mined and refined, its ongoing climate impact is virtually zero. 99% of the climate change emissions come in scope 1 and scope 2. Once you've turned it into its pure form, it doesn't actually contribute any ongoing emissions. And that's, if you think about, if you own a share in any company, that company, through its activities, has a climate change impact. And there are very few that are net zero at the moment, but in general, they're not. So if every year you're owning a share of this company, you're owning a share of its climate emissions. Gold has none once it's been refined. So by buying gold and putting it into your portfolio and thinking about the ongoing emissions as a consequence of that portfolio, you're actually lowering the carbon intensity of that portfolio. You're also having an asset which tends to do well when bad things happen. And as we've seen over the last few years, those bad things can be many different things. They can be health emergencies like the coronavirus pandemic. They can be bank crises like the global financial crisis or the mini run we saw in the US this year. It can be the Russian invasion of Ukraine. If you were to get an environmental catastrophe that would cause financial markets to weaken, gold would probably help protect your portfolio as well. So it gives you resilience to a portfolio from the potential climate change shocks that we're going to see to global economies and individual economies and companies, etc. So there's a lot of positive stories to tell about gold and ESG. And as I mentioned before, there's a lot of work to be done in terms of the mining industry, but at least we've quantified what needs to be done, and there's a clear pathway being laid out which will allow that to happen.
That should help, I guess, to not only the companies per se, but also the investors in making their decisions. Let us now talk about India-specific factors. Sheela, if you could tell us about the trend that we are seeing lately, especially I think since last September or so, there have been increased allocations to gold by mutual funds in India, and this has been as a part of multi-asset allocation strategies. So how do you look at this trend?
Yes, I mean, you raised a very good question. Multi-asset allocation, as the name suggests, provide an investment vehicle that automatically invests in various asset classes. And, typically the bifurcation is equities, debt, and gold. Now, a multi-asset allocation strategy in itself saves the investor the time and the effort to research individual asset classes, and, it also caters to different investment objectives. Typically, having gold in a multi-asset fund has a lot of advantages. I mean, we've done an analysis with a typical hypothetical fund where the fund has about 54% fixed income, 43% equities, and 3% alternates. Now, if you add gold to such a portfolio, what it does is it reduces the portfolio volatility. You could add anywhere between 2.5 to 10% gold, and progressively with the addition of gold, the volatility goes down. What also happens is, the reward to risk in the portfolio goes up, because gold is a diversifier, as John has explained earlier, right? It really offers diversification in a fund, and therefore it also improves the risk-adjusted returns, across various levels of risk. So clearly, I think what fund houses in India and investors have realized is that having gold in a portfolio is not only beneficial, it actually improves the annualized returns, and therefore it's becoming very popular. We've seen more and more fund houses actually launch new gold-backed funds, and the trend likely is going to continue.
Okay, so you do look at this trend to continue going forward as well.
Yeah, because see, if you look at it, the number of investors investing in the Indian markets itself has gone up. obviously, and while some people would like to take risks, there is an equally risk-averse population who want to manage that risk. And having gold, like I said, does improve the portfolio, not just in terms of its performance, but also in terms of its risk-adjusted returns.
Very true. Yes. And lately we've had a period wherein bonds and equities were both going down together. So especially for such periods. Yeah. So now, Sheela, I'm kind of curious. I also from the investor's perspective, because I was reading a report and that was more of a global report, but which talked about the latest trends in terms of different generations. So it said that Gen Z was more inclined to invest in digital gold, and as compared to Gen X, which were more they preferred physical gold more, and millennials were somewhere in between. So is there any such trend that we are seeing in India? I mean, I'm definitely seeing that Gen Z is very curious about their investments. So is there any such attitude that you found in India?
I think in the last 3 years, what we've seen is there has been an increase in the number of folios in gold ETFs alone. Last 1 year, we've seen a growth of about 44%, and this kind of matches with the overall growth in mutual funds. If you look at the assets under management or growth in folios alone has gone up by over 19%, and clearly, investors have realized that there is an option of having gold, but you don't need to have it only, through the physical means. What gold ETFs or gold savings funds or multi-asset funds actually offer an investor is the option to have gold in their portfolio in an online or a dematerialized form, and the accessibility is just through the click of a button. You can buy and sell whenever you please without actually having to step outside of the confines of your home or office. So yes, the trend is changing. People have realized that there is a product called gold ETFs or a multi-asset fund through which you can have the exposure to gold. And obviously physical gold, you could have it for adornment purposes if you're buying jewelry. But this gives you the option of having it in an electronic mode, and the convenience of buying and selling without stepping into a store like you would have to do for a jewelry is what entices Gen Z, who are interested in prepping up their investments to cater to the future.
Interesting. So the ease of access and the digitization is going to really help spread the word for such products.
Yes.
And while we are at it, these generational names, I just came across one today which said that young millennials. Now, so far I was used to the word millennials, but now apparently they've divided into young and old. And I'm like, okay, this was not required. But yeah, jokes apart, it was entirely warranted. And thank you so much, Sheela. And thank you so much, John, for sharing all the insights. I think there is a lot to learn about gold and its attributes from this conversation, not just for myself, but for all the listeners. So thanks a lot. And I thoroughly enjoyed this conversation. I hope to have it soon again with you. Thank you.
Thank you.
Thank you very much.
Thank you to all our CFA Society India podcast listeners.
Thank you for listening in to today's podcast. Before you go, please subscribe to stay updated on your favorite podcast app.